So payroll optimization. So this is basically the perspective of how can I maximize compensation for you as a small business owner and your family? What can we do? Are there strategies in place that we can utilize? And so payroll optimization, who can benefit? Well, adding a spouse. As we all know, spouses are sometimes working full-time in your business, or they're just helping out as needed. And so clearly there has to be, you can add your spouse to payroll as long as they're doing work and they have a job description. And one of the reasons why you would do that is you can increase retirement plan contributions by, in most cases, over $55,000 a year. And that accomplishes two things. It puts more money away for your retirement, but it also helps to save some taxes. Adding your children to payroll, that are in junior high, high school, and college. And, one of the things that we know, because we work with a lot of higher net worth business owners, is that the value to children is the benefits of working at a young age, the benefits of understanding the family business. And so, but you have to be reasonable with this. You have to pay them a reasonable wage based on the work that they do, documenting things like time cards and job descriptions, right? So you have to go through the process of, if you're going to utilize this as some tax savings, is making sure that you're doing things that are above board and that you're documenting it. And really the benefit for taxes is you get larger tax deductions for your business and personal tax return. Then we look at retirement plan strategies. So this is really ensuring that your retirement plan is utilizing all available tactics to optimize tax and saving strategies. So that's the simple goal. What's the goal of your financial plan? Is it to save taxes? Is it to maximize retirement savings? What are the things that I really want to look at? And that's what this section is going to go through. And one of the things that I'll pivot here in a second, but so retirement plan strategies, who can benefit? So for you and your spouse, adding your spouse to payroll allows them to maximum fund a profit sharing plan, which allows you to get more money. You can also consider a Roth 401k. Many business owners are not eligible for a Roth IRA, but they are eligible for a Roth 401k. There's no income restrictions. So it allows them to have an account that builds tax-free. And I know tax-free is one of the areas we always like to hear as a business owner, but most business owners are not taking advantage of the Roth option. And then for your children, by adding them on payroll, the ability to pay some of your college expenses, funding a 529, also the ability to fund Roth IRA accounts early. So, and early in life, because we know the benefits of compounding. So this is what we're going to go through. So we're going to pivot now into some specifics around these strategies. And I apologize ahead of time because there's a lot of data on here, and I'm going to try to slow down a little bit as we go through this. But we're going to go through some examples. And so what we're looking at here is a hypothetical. So I'm going to walk you through kind of the initial scenario, and then the stories are going to kind of build on themselves. We've had to make a lot of hypothetical assumptions in here. So I just want to let you know that this is hypothetical. It's highly accurate. I can't tell you it's perfect, but it's very close to that because we're using spreadsheets and not some of the tax software. Just trust me, generally we're in the right vicinity, but it's mainly to get the concept of, what are some of the things you can do. So this is what I would call the traditional way of funding a retirement plan, where it's just the owner, spouse and children are not involved. And you can see in the scenario, we have the primary owner is 50 years old. This is a business that's doing quite well. The owner is taking W-2 income of $350,000. Business net income prior to the payroll is about $1 million. So they're doing quite well. And one of the things that I will tell you is this applies to you in a scenario where your profits are $200,000 or $300,000. So this is not just for the larger, it really does encompass it. Now, we do know how the tax code is built. The higher the bracket you're in, the more bang you get for your buck, right? The more value you get in some of these strategies. If you're in lower brackets, some of these strategies might not apply. So if you notice what I've highlighted here in red is the ability of this owner to put pre-tax contributions, which means they get a tax deduction of $64,500. That money gets to be saved into their retirement plan, and their net savings because of that contributions is around just over $31,000. And this is going to change based on California tax rates and federal, but this is the current saving. So this is why people like using 401ks, profit sharings, especially when it's just the owner, there's no employees, because you can save on a pretty hefty retirement plan contribution, almost 50%. So then we look at the next kind of phase. Well, what if I add my spouse to payroll. She's working for the company, and he or she is working in this scenario. Actually, I have it reversed, but you can see because in this scenario, we're looking at Angela. She's the single owner, right? So her husband does work for the business, is getting added to payroll. And so if you notice the W-2 income, her W-2 income dropped to $285,000, and the W-2 income for her spouse, her husband, is at $65,000. So all the data is essentially the same, but by adding the spouse to payroll, now the total pre-tax contributions for this plan is $129,000, which basically what I highlighted in blue and in yellow at the bottom means that by doing so, this couple can save an additional $25,000 in taxes. And so that's pretty powerful, right? By just doing that, you're going to save not only for retirement, but also for in taxes, which is obviously many of our goals. So the one thing that I do want to add into here is, and you can see in the headline, how much can I save, but adding the Roth 401k. So this is something that too often than not, business owners are not looking at. And so what I actually looked at here was, okay, we're going to assume that the contributions are going into the Roth, 100% of it. And you can see what I highlighted in red. The pre-tax contributions are at $77,000 for husband and wife. And the Roth contributions are at $52,000, which is the max that they can do. And then I highlighted at the bottom, well, what is the additional tax savings? And so look at that number. It's basically negative $76. So that means in this scenario, there is no tax savings by adding the Roth. But I'm going to illustrate later why that matters. Because remember, a Roth 401k is not a deduction. You cannot, it's not a tax deduction. So in this scenario, by adding the spouse, but by being able to put away $52,000 per year into a Roth account, there is no additional tax savings to that dynamic. It's the same from a tax perspective, but it's different because now you're putting money into a Roth. So hopefully that illustrates the point around how to utilize a Roth in terms of looking at payroll and retirement plan optimization. So this last one gets a little bit more complicated. I highlighted here, I probably should have made that circle a little bit bigger, but I just kind of said child 1 and child 2, right? Really just looking at a scenario. Now you can run this for 1 child, for 4 children in a family. And this is just looking at a scenario where you pay a little bit over $1,000 a month to each child for the work that they're doing in the business. And kind of the summary of it all, as you can see, basically inside the box in the bottom right corner, by adding the children onto payroll and paying that amount, that we're going to have a net savings of around $10,000. And so putting around $26,000 away does, you do incur some additional costs like payroll costs. You do have some additional taxes, but in this situation at a higher income individual or higher income family, it'll save about $10,000 per year in taxes. This also opens the opportunity up. You can see in the boxes on the right-hand side, outside of the box, it says Roth contribution and 529 contribution. The whole idea, with having the kids work for the business is that, you want to utilize these things to set themselves up for the future. So you have the ability to put this cash flow away in Roth IRAs and or college accounts, depending on the situation. So now we're going to dig into some of the benefits of like the growing of the wealth, right? We focused on some of the tax savings and some of the ability to put money away. So one of the things that I want to illustrate here is, what if you could fund this Roth and put $52,000 away? And the reason why we're bringing this up is we know tax rates are going to go up, right? Our deficits are north of $30 trillion. We know tax rates are likely going to go up. So, many people are starting to focus on, well, what can I do tax-free, or what can I do that's not going to exacerbate my tax liability later in life? And so what I'm illustrating here, and I had to make a lot of assumptions, we're using an 8% expected return. We don't know what the future is going to be, but I had to make some assumptions. So this basically assumed that you saved $52,000 for the next 10 years. And then in the bottom left corner, you can see what the future value is. And so in 20 years, that bucket would be worth 1.6 million. In 25 years, it would be worth 2.4 million. And in 30 years, 3.5 million. So the power of just putting away 10 years worth of max funding the Roth, when you compound that over a period of time, you've now just created these massive tax-free accounts, these Roth accounts for later in life. And if you take the same approach to a traditional 401k or a pre-tax, you actually can still accumulate the same amount of money. The difference is if that account grows to 3.5 million, when you take it out at a later time, you have to pay ordinary income tax. And so if you're required to take 100,000+ out, that's going to cause a larger tax exposure to you, which is what makes the Roth extremely palatable. So that's number one, really kind of for husband and wife, looking at the ability to save into the Roth and the long-term compound benefit of that. The other thing is, what I would call investing in your children, for your children. So what's the long-term benefit? So let's just, suppose you had a 16-year-old and you're like, okay, this 16-year-old is going to work for me for a couple of years in high school, a couple of years in college, and really we're going to fund this for 6 years. So I highlighted the annual savings. We're just assuming $6,000 a year for 6 years, which is the maximum amount. And then I want to show you the true benefit of compounding. So this supposes they don't add any more money to it. They stop funding it at age 21. But in 20 years from then, it'll be worth 120. And now remember, we've only put in 30,000. And 20 years from now, that would be worth hypothetically at 8%, 130,000. And at, in 52 years, which would get them to, 52 years from then, it would get them to 1.5 million. So think of the impact of being able to start early for your kids and just depositing 30,000 over that 6 year, 36,000 over that 6 year period. The benefit of compounding in a tax free account like a Roth IRA, over the next 20, 30, 40, 50 years has a tremendous impact. And so I definitely see a lot of our clients who are excited to leave a legacy for their kids. They don't want to give it to them now. They don't want to just blow the money. They want to really invest in their future. So the benefits of starting early are pronounced. And hopefully this chart gives you a little bit of that, gives you a little bit of that picture. And you can see on the left-hand side, that would get them to age 67, which right now is typical retirement. For kids that are younger, likely retirement is going to get pushed out.